All right, it's 9 a.m., so let's get started. So this week's topic is top-down approach and capital market expectations. So I will make some change of the structure of this week's session because many of the questions on the wrap-up quiz are concept-based. So I will just review some of the important concepts while I go over the quiz questions. All right. So the first question is asking about the bottom-up approach and top-down approach to security valuation. And we are asked about what are the advantages of a top-down approach. So first, let me review what are bottom-up approach and top-down approach. So the bottom-up approach focuses on individual securities such as stocks and bonds. It emphasizes the fundamental analysis of an individual firm. It focuses on the analysis of financial statements, the firm's earnings, and some valuation ratios. So a basic belief underlying the bottom-up approach is that the undervalued stocks will perform well regardless of industries or economic conditions. On the other hand, a top-down approach starts with the macroeconomic analysis. That is the analysis of the global and domestic economies. It then moves to the industry analysis and finally the analysis of the individual securities. So the top-down approach focuses on macroeconomic indicators such as GDP growth, the interest rates, inflation in the economy, and also the economic cycles. So this approach selects industries that are likely to perform well given macroeconomic trends. And it chooses the top performing stocks within strong industries as a result. All right, so these are the points that you should cover in your answer. And it will be graded on these points. And there is a brief summary of these two approaches. Again, the top-down approach analyzes the entire economy first and then move to sectors, industries, and finally it chooses one stock that is top performer in the industry. And the key factors include macroeconomic trends and industry growth. So the bottom-up approach only focuses on the selection of individual stocks, and the key factors include the financial statements of the firm and the its valuation and its growing potentials of the firm. All right, so what are the advantages of the top-down approach? Firstly, the top-down approach has a structured analysis, meaning that it provided a systematic approach by evaluating the economy, the industries, and then the individual stocks. So this approach incorporates economic and financial variables into stock analysis, as the prospects for a particular industries are very likely to correlate with the broader economic environment. And we recognize that the company's performance is also highly dependent on the industry outlook. So it makes sense to start with the broader economy and then move to the finer level. The second advantage is it can properly manage the risk because it enables identification of high growth industries which benefit from favorable economic trends. And this will help investors avoid weak industries or stocks that may struggle due to the adverse economic conditions. And finally, this approach will narrow down investment choices, focus only on the industries and the companies that has strong growth potentials. All right, so that's the end of the first question. Let's move on to the second one. The question is, what characteristics will usually result in firms having greater sensitivity to business cycles? So we are given 4 kinds of firms to consider. So let's go over it one by one. So first of all, we consider the durable goods producers. So some of the examples of durable goods are automobiles or appliance. They are usually not daily necessities. So the purchase of durable goods can be deferred during a recession. The customer purchase more during expansions, but will purchase less during recessions. So the durable goods are highly sensitive to business cycles. And secondly, let's consider the capital goods producers. The capital goods are goods that used by other firms to produce their own products, such as the manufacturing equipment. So when the demand is slack in the economy, fewer firms will be expanding and purchasing capital goods from other firms. Therefore, the businesses invest in capital goods when demand is high, but cut spending in economic downturns. As a result, the capital goods are also strongly impacted by the business cycles. Next, let's consider the financial companies such as banks. We know that banks benefit from strong loan demand in expansions, but it will face higher default risk and lower borrowing activities in recessions. Specifically, during the economic growth, businesses and consumers borrow more for expansion and consumption. And the interest rates are generally stable or rising in an expansion economy. Therefore, the bank's profitability will boost. However, in an economic downturn, it leads to job losses and business failures and increasing credit defaults. Therefore, the banks may experience losses due to unpaid loans and stricter lending standards. Also, the customers and businesses cut spending and avoid taking on new loans due to uncertainty, and the lower interest rates may reduce banks' interest income and overall profitability. So the financial companies is also sensitive to business cycles. Lastly, the companies that produce consumer staples. We know that in contrast to durable goods, the essential products such as food, pharmaceuticals, and utilities are constantly demanded, no matter the economy is in an expansion or in a recession. Therefore, the producer of consumer staples are less sensitive to business cycles. So in summary, the durable goods producers, capital goods producers, and the financial companies are all very sensitive to business cycles, whereas the companies that produce consumer staples are less sensitive. All right, if no question, let's move to the third one. In this question, we are required to match the 4 industries to the economic scenarios in which it is likely to be the best performer. So the industries are housing construction, healthcare, gold mining, and steel production. The economic scenarios are stagflation, deep recession, superheated economy, and healthy expansion. So let's see. Let's first review the types of industries. Cyclical industries performance is highly correlated with the economic cycle. And this kind of industries will grow during economic expansions but decline in recessions. This is because the goods in these industries are not daily necessities. For example, the automobiles, luxury goods, travel, constructions, or steel production industries. And the non-cyclical industries, or we call it defensive industries, maintain stable regardless of economic conditions. It is less affected by recessions because the products in these industries are essential goods for consumers. Examples include healthcare industries, utilities, consumer staples such as food and household goods. And a third category is called the counter-cyclical industries. It will perform well during economic downturns, but may struggle in strong economic periods. This is because investors will seek these industries as safe haven assets during uncertainty. Examples are gold mining or discount retail. So let's consider housing construction first. We know that the housing construction is a cyclical industry that's highly sensitive to interest rate and economic growth. This is because in an expansion, rising GDP, lower unemployment, and stable interest rates encourage housing purchases and retail estate investments. And during expansions, consumers and business are more confident in spending on new housing projects compared to in a recession period. Therefore, the housing construction industries will perform well in a healthy expansion economic environment. Next, let's consider the healthcare industry. So healthcare is a non-cyclical industry, meaning that the demand remains constant regardless of economic conditions. It makes sense because even during a recession, people still require medical treatments, prescriptions, and healthcare services. So it is less affected by the economic cycles. Unlike luxury goods, the healthcare spending is essential for the customer and is stable during different recession or expansion periods. Therefore, the healthcare industry will perform as good in the deep recession period as in the expansion periods. Okay, so for the gold mining industry, it is a counter-cyclical industry, meaning that it performs better during economic instability. In a stagflation period, which is marked by the high inflation and falling GDP, the investors seek safe haven in this safe haven assets like gold and some other asset that can preserve value. This is because gold prices typically rise during inflationary periods when fiat money loses their purchase power. So the gold mining industries will perform well during a stagflation period in the economy. And lastly, the steel production industry. It is highly cyclical because the demand rises with infrastructure projects, manufacturing, and industrial expansion. In a superheated economy, which is marked by the high GDP growth, rising inflation, and interest rates, the government and businesses invest heavily in construction and industrial expansion. Therefore, higher inflation increases material costs, but it is still economic demand. But the strong economic demands will drive the steel industry profits during the superheated economic period. Okay, so the fourth question is also about the business cycle sensitivity. For each pair of firms, choose the one that you think would be more sensitive to the business cycles. So we are given two pairs of firms. So let's consider the General Autos and General Pharmaceuticals firms first. So General Autos company is in the cyclical industry, whereas the General Pharmaceuticals company is in the non-cyclical industry. This is because the consumers only buy cars when the economy is strong, but delay the purchase of cars during recessions. The cars is not a daily necessities, and it's considered as a discretionary purchase. On the other hand, demand for medicines remains stable regardless of economic conditions because the pharmaceuticals are necessities for our daily life. As a result, the auto industry is more sensitive to economic fluctuations than the pharmaceuticals industry. So the correct answer for this question is General Autos. All right, let's then consider the airline companies and the cinemas. The airlines is in the cyclical industries, and the cinemas is also in cyclical industry. However, the sensitivities to economic conditions are different. We know that travel is a high-cost entertainment options, so people will cut travel expenses during economic downturns. Therefore, travel is highly sensitive to economic conditions. Whereas movies are a lower cost entertainment options, meaning that the demand remains steadier in economic downturns. As a result, the airline industry is more sensitive to the business cycle than the cinema industry because the differentials in cost in these two options. The correct answer is the climate-friendly airlines. It is more sensitive to economic conditions. All right, any questions? Okay. Let's move on to the question 5. So we are given that an unexpected expansionary monetary policy has been implemented. The question is asked us to indicate the impact of this policy on the following variables, such as inflation, real output, real interest rate, and nominal interest rate. So just to quickly review, the expansionary monetary policy will increase the money supply, and as a result, it lowered the interest rate and stimulate investment and consumption demand in the economy. First of all, the impact on inflation. The expansionary monetary policy increases the money supply in the economy. So if the policy overstimulate the economy, the demand will rise faster than supply. Therefore, the prices increases, which will lead to inflation. Also, the ultimate result of more money being injected in the economy is higher prices, which will also lead to inflation. Therefore, the inflation in the economy will likely to increase. And the impact on real output. Because the money supply in the economy increases, the lower interest rates will reduce the cost of borrowing, encouraging the business's environment and consumer spending. And then the increased spending will boost employment and production, leading to higher GDP. In the short run, the higher demand drives economic growth, but in the long run, the supply constraints or inflation may limit growth. So if we are considered the short run, the real output is likely to increase. So the expansionary monetary policy increased the real output or the GDP in the economy. Thirdly, the impact on the real interest rate. The real interest rate is adjusted for inflation and it reflects the true cost of borrowing. An expansionary monetary policy increases the money supply, which will make the funds more available for lending for customers. And as the borrowing costs decline, the real interest rate decreases, which will then stimulate investment and spending. Therefore, as a result, the real interest rates are likely to fall during the expansionary monetary policy period. Lastly, we consider the impacts on nominal interest rate. As a reminder, the nominal interest rate consists of real interest rates plus the expected inflation. So there are two opposing forces to consider. First of all, the real interest rate falls. because the monetary expansion increases liquidity, which will result in a real borrow cost to decline. On the other hand, the inflation rises, which is a result from part one. The inflation increases. Higher inflation expectations may push the nominal interest rates up because it affects the second part of the nominal interest rate. Therefore, the net effect depends on the strength of each force. If the rising inflation dominates, the nominal interest rate will increase. However, if the declining real interest rate dominates, the nominal interest rate will decrease. So as a result, the nominal interest rate could either increase or decrease depending on the strength of the two opposing forces. Okay. Let's move on to question 6. It is asking about the required rate of return. This company is currently pays a dividend of $1.22, which is expected to grow indefinitely at 5% per year. If the current value of the share in the company based on the constant growth dividend discount model is $32.03, what is the required rate of return? First, review formula for the constant growth DDM. The current value of a share of stock is equal to the next year's expected dividend divided by the required rate of return minus dividend growth rate. So this is the constant growth DDM formula. Let's first calculate the first component, the next year's dividend. So D1 is equal to the previous year's dividend times 1 plus the dividend growth rate. So plug in numbers, 1.22 times 1 plus 0.05, which is the dividend growth rate, we get the answer of 1.281. And next, we solve for the required rate of return by rewriting the DDM formula. It can be rewritten as the next year's dividend divided by the current value plus the dividend growth rate. So we then substituting values. D1 is equal to this, and the current value of a share of stock is 32.03 plus the dividend growth rate, and we write the final answer in the percentage form, which is 9%. All right, so this question should be very clear if you remember the formula from the DDM model. The next one is quite similar. A firm pays a current dividend of $1, which is expected to grow at a rate of 5% per year. If current value of the firm's share is $35, what is the required return based on the constant growth dividend discount model? So we have the same formula here. the current value is equal to the next year's dividend divided by the required rate of return minus dividend growth rate. So following the same procedure, we calculate the next year's dividend first using this formula, and we get a number of 1.05. And next, we again solve for the required rate of return by rewriting the DDM formula. And we plug in the number for next year's dividend, 1.05, and the current value, $35. And then we plus the dividend growth rate, 0.05. Write the number in percentage form, and we get 8% required rate of return. So it's quite similar to the question 6. Okay, any questions for these two questions? Okay, if not, let's move on to the last one. So we are given that we are given the information that look at forecasting the equity markets in the same way as the process for individual stocks. So some informations are the return on equity is 9%, the beta value is 1.25, the retention ratio, we denoted as B, is 2/3, and this year's earnings is $3 per share. And some additional information, the annual dividend was just paid. The consensus estimate for next year's market return is 14%, and the treasury bills currently offer a 6% return. So we are asking about the price at which the analog stock should sell and the PE ratio. Okay, so let's first conduct a stock valuation. So the first step is to compute the required rate of return, K. So as a review, we know from the capital asset pricing model, the required rate of return is equal to the risk-free rate plus the beta coefficient, and it times the market risk premium, which equals to the expected market return minus the risk-free rate. So given this formula, we can plug in numbers to solve for the required rate of return, which is equal to the 6% risk-free rate plus 1.25, the beta value, times the expected market return, 14%, minus the risk-free rate again, 6%. So solving for this equation, we get a 16% required rate of return K. And the second step is to compute the growth rate. The formula for growth rate is the retention ratio times the return on equity. So the retention ratio is 2/3, and the ROE is given as 9%. So the growth rate is calculated for 6%. Okay, so with the first two steps, we can move on to calculate the next year's dividend. The formula for the next year's dividend is equal to the current earnings per share, current EPS, times 1 plus the growth factor for earnings, the growth rate, and times the dividend payout ratio, which is equal to 1 minus the retention rate. All right, let's substitute numbers into this formula. Next year's dividend is equal to 3 times 1 plus 6% times 1 minus 2/3, which is equal to 1/3. So D1 is equal to 1.06 as a result. And finally, we can move on to calculate the stock price. Oh, there is a typo. I should denote it as P0. Or P0 and V0 can used interchangeably. So the current stock price is equal to minus K D1 divided by K minus G. So D1 from previous part is equal to 1.06, and the required rate of return is 16%. The growth rate is 6%. So we get the final answer of stock price equal to $10.6 per share. Okay, so any questions? The next part is asking for the price to earning ratios. So first of all, let's be clear about the difference between leading PE ratio and trailing PE ratio. So the leading PE ratio uses the projected future earnings. That is the earnings in next year, E1. However, the trailing PE ratio uses the actual earnings, which is the earning in this year, E0. So to calculate the PE ratio is fairly simple. Just use the price divided by earnings. Okay, so the leading PE ratio is first calculate the earnings in next period, which is 3 times 1.06, which is 3.18, and use it as E1 and plug in to the formula, and we got 3.33. Next, the trailing PE ratio is the same thing. Use the price this year divided by the earnings this year. So we get a number of 3.53. Okay, so that's the end of all the wrap-up quiz questions. Any questions for me at this moment?